In this video, I'm going to show you the journal entries to record and eliminate sales tax payable. If you're not familiar with this account, sales tax payable is a current liability reported on the company's balance sheet, aka statement of financial position, and it represents sales taxes that have been collected by the company on behalf of the government. So what the company's going to need to do is record a liability when sales tax is collected, because the company doesn't get to keep that money. It has to turn it over to the government, and it's going to then reduce the liability when that sales tax is turned over to the government. Okay, so the company's going to collect money on behalf of the government, record a liability, and then reduce that liability after it's turned money over to the government. So let's do an example. Let's say the company WeatherPod sells one unit of one of their products for a retail price of $120. So when I say retail price, I mean this is the selling price of the product, okay, which as you can see here is some kind of device that you wear to prevent getting rained on. Wouldn't recommend walking into a business meeting wearing that, but hey, who am I to judge? In any event, so you pay, a customer pays $120 before sales taxes are applied, and let's just assume that there's state and local sales taxes of 10% that apply to the transaction. So actually what the customer is going to pay is the $120 price plus 10% of state and local sales taxes, which would be an additional $12. So basically the customer is going to pay $132 in total, but we will get to that. Also, we need to know for making the journal entry what it cost WeatherPod to make this product for debiting cost of goods sold and crediting inventory. And so we'll assume that that's $70. And then, so this took place on May 1st, and we're going to record the sale. I'll show you the journal entry in a moment. And then a couple weeks later, so May 15th, WeatherPod turns over that $12 of sales taxes to the governmental authorities. So I'm going to show you how to make the journal entries for all of this. Let's start with recording the sale. So on May 1st, WeatherPod is not just going to get the sale price of $120, but they're also going to get the $12 of sales tax. So the cash that is going to be debited, and I'm assuming this is a cash sale. I should have clarified. This is not a credit sale. We're assuming a cash sale here. Okay, so they're getting $132 of cash. Okay, so the company is taking in the $120 selling price, plus they're collecting the $12 of sales taxes on behalf of the government. So thus, you'll see there's also a liability being credited, sales tax payable, because there's 12 of that 132 is going to need to be turned over to the government at some point in the future. Now, we'd said it cost WeatherPod $70 to make the product, so they need to debit cost of goods sold for $70, and then they need to credit inventory for $70. So basically it's a normal sale here. The only difference is because sales tax applies to the transaction, the cash is a little higher than if there was no sales tax applying to this transaction. And then note, the thing that throws some people off, the sales revenue is $120. Okay, it's the selling price of the product. It does not include, so it's not the $132, because 12 of that $132, that's not sales revenue for the company. That's money they're holding on behalf of the government. And again, the sales tax, I just calculated the selling price times the tax rate, which in this example is 10%. So that's where I got the $12 of sales tax payable. So again, key takeaway, sales revenue is the price of the product, the selling price, and it does not include the sales tax. That sales tax right here is a liability, specifically a current liability that's going to be reported on the balance sheet. Now, May 15th, I had said in that problem that the company goes and turns over, pays that money that they had collected previously on behalf of the governmental authorities. They pay that money over to the governmental authorities and say, look, hey, we collected these sales taxes on your behalf. Here are those sales taxes. What they're going to do is they're going to credit cash for $12, because you got $12 going out of the company's doors, right? But they're going to debit sales tax payable for $12 as well. Why? Because it's a liability, right? It's a payable account. It's a liability. Liabilities go down with a debit. If you're not too good on your debits and credits, what you want to think about is this is reducing the liability. Okay, and in fact, in this case, assuming there are no other sales taxes payable or anything like that, this would completely eliminate the liability, right? Because we started with 12, then we reduced it by 12, we're at 0. But in reality, the company probably has other sales taxes they collect on behalf of other sales of other products. But we are reducing the liability. So the liability has been reduced on the balance sheet because the company no longer has that obligation to turn over the sales taxes because it has done so on May 15th.